deficits are bad, right? Deficits are bad because it forces our government to create debt to cover the deficit, right? They borrow the money to cover the deficit because tax receipts can't do it, right? That's a part of the problem. A big part of the problem, though, a bigger part of the problem, I should say, is that the Federal Reserve prints money to buy the deficit. So they monetize the debt. The more they print, the double dose of badness that goes into the inflationary metric.
Right.
And what's the answer? What's the solution, right?
Hello, and welcome to the Infinite Financial Freedom Podcast, where we empower you with financial literacy and guide you on your journey to financial freedom. I'm Josh Mettle, and I'm here today with Dan Calandro from Cal Management Group. Dan is a financial scientist and a Wall Street clown killer. That happens to be the coolest title of anyone I've ever met in my entire life, so we want to dig into that. But since 1995, Dan's portfolio has grown by an astounding 3,600%. Dan is also the author of Lose Your Broker, Not Your Money, where he untangles the mystery of successful investing. No doubt this is going to be an incredible podcast. So welcome to the show, my friend.
Thank you very much. I'm glad to be here. Thanks for introducing me to your audience. I appreciate the opportunity. Thanks.
Yeah, I'm really looking forward to this podcast because you're a big thinker, Dan, and we need big thinkers right now because there's big problems. And so let's do this. Give us just a 30-second overview of your journey through this financial world up until now, and then I want to get right into some really big topics with you.
Yeah, okay, great. I became interested in the stock market on October 19th, 1987, Black Monday.
Wow.
I was in college. I was a senior in college, and I never wanted to get into it, never wanted to go on Wall Street, but always interested by it. I wanted to be a corporate finance guy, a CFO, and been there, done that a couple of times. And really, ever since then, it's been a hobby of mine. It was the thesis of my graduate school final project, so to speak, where I developed this method because I couldn't find the answers I was looking for in college books or graduate level books, right?
Mm-hmm.
And now what I do is I wrote the book a decade ago, I guess now, and I coach people, teach people, coach people, and support people to take control of their, investment assets, because it's not that complicated. Actually, it's easy if you think about it. So yeah, that's it for me. Yeah.
I love it. I believe that having agency and dominion over your own investments is not only valuable for you because you, in many cases, will pay less in fees and can do as good or better of a job, but maybe more importantly than that, the education that comes along with it. And I have a firm belief that an inheritance shouldn't be first and primarily a financial passing of wealth. But first and foremost, it should be a passing of financial information and a model and a way to look at the world. And when you give all that power to a financial advisor, and there's some great ones out there, so I don't mean to just speak negatively on the whole industry, but when you abdicate all of that journey to somebody else to run for you, it's really hard for you to pass down those lessons to our children. So I couldn't be more aligned with you on that point.
And I couldn't agree more with you. And thank you for that. The best legacy you can leave is a winning method.
That's right.
And Josh, it goes back, right? I didn't invent this, you didn't invent this, throw somebody a fish, you feed them for a day, teach them to fish, you feed them for a lifetime. I mean, that's been around for a long time, maybe even since Jesus, right? But yes, the greatest legacy, and most people that come to me are scared and nervous, and rightfully so, and we could get into that, but their point is I don't listen, I trust my financial advisor, I like my financial advisor, but I just don't understand. And it scares me to not understand because I see, what's going on in the world. And I can't blame you. The more you know, the less scared you'll be, or maybe not because it's a scary world. But to not educate yourself, to blindly hand your money over to somebody else because you lose a piece of it every time you hand it over. because they have to make money on your money, right? To blindly hand it over is a very, very uncomfortable position. I couldn't agree more. Method is the most important thing.
Well, the stakes are so high. You know, if that person that you've abdicated that responsibility to makes a mistake or has you off track, the consequences are grave. And we have a saying in our company that competence equals confidence. So if you want to be more confident, you got to get in and you got to start learning it. And the only, I mean, I read very well from the written word, but I learn exponentially more by the physical application of that, making small mistakes and learning and then optimizing from there. So this is great. I'm excited of the way we've started. I want to throw you what I think is the biggest potential problem in the financial markets. This is the elephant in the room, in my opinion, and that is the massive federal government deficits. We are borrowing as a country about $1 trillion every 3 months. That is not normal. That is not healthy. That is a credit card. And at some point, we will reach the credit card limit. And they will be, well, I think what I've heard you refer to as the Great Devaluation. So I really want to understand that. And look, you know, the federal debt since before COVID has, and I can't remember the date. I was just reading an article on it this morning on Zero Hedge, and I think it was from 2020 that the national debt is up $11 trillion. I mean, it is just astronomical, the speed at which we are going into debt. So how do you look at that? What is the Great Devaluation, and how does that impact your investment decisions?
Yeah, and all good questions, all big, really thick topics.
Big questions.
And,
We
yeah,
need a book.
and yeah, and you know, when you think about it, and you're right on, Josh. When you think about it, when Bush left, George W. Bush left office, there was 10 trillion in debt. When Obama left, there was 20 trillion. Okay,
Wow.
It's 35 trillion now. So I mean, Bush was in for 8 years, Obama was in for 8 years, and now Biden's coming up on the 8 years after Barack, right? So when you think about it, 10 trillion, not 15 trillion, it's crazy.
It's crazy.
Biden just submitted in a $7.3 trillion budget, by far the largest budget, which will increase the deficit by another 4 trillion. Okay. Now, deficits are bad, right? Deficits are bad because it forces our government to create debt to cover the deficit, right? They borrow the money to cover the deficit because tax receipts can't do it, right? That's a part of the problem. A big part of the problem, though, a bigger part of the problem, I should say, is that the Federal Reserve prints money to buy the deficit. So they monetize the debt. The more they print, the double dose of badness that goes into the inflationary metric.
Right.
And you know, what's the answer? What's the solution, right? And think about this in context too. The Federal Reserve printed $6 trillion of new currency and injected it into the system through the Wall Street establishment, because those are the money center banks, right? In 10 months during the COVID. So for anyone, including the chairman of the Federal Reserve, to say that inflation was going to be transitory, you know, temporary, you know, short term, is such a lie and such propaganda, right? How can you add $6 trillion of currency to a $20 trillion economy and not cause inflation? Because there's only one thing that causes inflation, and that is an inappropriate imbalance between the growth of the economy and the growth of the money supply. So when you add $6 trillion of currency, you have no choice but to create long-lasting inflation, and that's where we are. And then the monetization of debt goes on top of that. So now, in order to stop that, to get that fixed, you need to take some currency out of the market, right? Significant now. Remember, they put 6 trillion in just 10 months on top of the deficits, right? So how do you do that, right? So how do you slow down the supply and demand cycle of money and goods and all that stuff, right? Well, you got to take it out. They're taking out about $50 billion a month. That's nothing when you have such a big mess in front of you, right? It's nothing, right? So how do you do it? Well, you can't take it at all out of people's wallets via tax increases, which they want to do. But a tax increase is just politics, right? Because they're going to go after the middle class with that. And the middle class doesn't have enough money to pay off that nonsense, right? The trillions of dollars that they have to get. So they're going to take it out of your retirement account. That's how they're going to do it, right? They'll choreograph, and of course, it's easy to choreograph a major stock market correction because really only 25 to 50 stocks, move the market averages. And they'll suck it out of the air, right? Have people sell in panic like they do, and this, that, and the other thing. But the major stock market correction will cause people to save more to replace that savings and spend less. And then we're sliding into a recession right now. You can see, technology is laying off, and it's just going to, kind of bubble down. With unemployment, people earn less, they spend less, right? And again, I see a perfect storm coming, and who couldn't predict the perfect storm around, Biden, Trump again? I mean, Biden's policies have been a failure. I mean, any objective independent like me can see it. Trump is Trump. I mean, there is no perfect candidate. Reagan is dead. And the Great Devaluation, as we talked about, Josh, is not my term. It was a term that I first read in the book called The Fourth Turning by historian Neil
Howe.
Yeah. And that book, is amazing, right? Pathetic, really. You got a guy in 1993 writing a book that's predicting September 11th, COVID-19, the '08 crash, and then what he calls the Great Devaluation. And if you see that post I posted on LinkedIn about central bank digital currencies, that's what I see happening. We all have too much debt. Everybody followed America with COVID. Everyone followed America after the '08 crash. Europe is underwater worse than we are. China struggling too. So what do, right? You create new forms of currency. You devalue everything. You reset everything, so to speak. You put a basket of them together to serve as the world reserve currency to, really stop the US dollar from having all that clout and control, and you can see it happening. Well, when the rest of the world stops keeping our currency as a reserve currency, those dollars come back to America. What do you think that does to inflation and interest rates? If people like, in the commercial real estate market, like of so well, a lot of those debt facilities refinance and, every 5 years or so, you bring back all that reserve currency, boy, we're in a real mess, right? And again, I say to people, educate yourself, get a plan, have an exit strategy, have a plan B, have a plan C, have a plan D. What if this happens? What if that happens? But I see, my book, published about 13 years ago, Lose Your Broker, Not Your Money. And it's available online on my website, loseyourBroker.com. Okay. And in that book, the first draft of that book was predicting that crash was going to happen. And by the time I got to the end and got the book done, it happened.
Books take too long, don't they?
Yeah. And especially when you're a finance guy and not a writer, it didn't come easy to me. So then you go back and you just cut out all the prediction stuff and you talk about it in arrears. And at the end of that book, I say the next crash will make this one look like child's play. And I believed it then, and I believe it now, because we kept doing the same things that got us into that problem. Printing too much, borrowing too much, derivatives and all that stuff, and mortgage asset-backed loans, they're still out there. That's still happening.
Leverage.
And sooner or later, the Ponzi scheme collapses like it did last time. And this one's going to hurt. Because now with inflation, you can't print your way out of it. You can't spend your way out of it. So they need a way out of it. And the way out of it is those central bank digital currencies that are going to reset currency, which is going to reset debt, which is going to make the stock market go down huge, right? Because they overreact to everything anyway, up and down. And not that the stock market's going to go away, because it's not. The dollar might go away as we know it, but it'll come back in a new form. The stock market, is how the donor class finances, the politicians who rule us. And like I say all the time to my members and my clients, it's their world. We just live in it, right? And the best time to buy is when everything is on sale and it's low. And the only way you can buy low is when you're competent and confident in your portfolio. And the only way to be that way is to know it, understand it, and for me, build it, right? And my method is all about stacking the odds in your favor. It's about not owning the United States military. It's about owning a Navy SEAL team. You want to go kill a guy like Bin Laden, you don't send the whole military after him. You send a Navy SEAL team. And it's easy to invest in a Navy SEAL because you believe in them. You're confident in them. And they're better than the average soldier. That's my 2 cents on it. That took about $1 to say, but
I think that was great. I want to ask a couple of questions about that. So when we talk about the Great Devaluation, what you're really talking about is the devaluation of the US dollar, correct?
The dollar and all the debt tied to it.
And all the debt that's tied to it. Okay, so therein lies a potential hint on how you might be able to make this coming devaluation a benefit for you. If you had a means by which to short the dollar, meaning that you gained as the dollar value goes down, then perhaps you could win from this coming event. So let's go back to Neil Howe. Neil Howe wrote a book called The Fourth Turning. And essentially in that book, he likens economic cycles, which he does by going back and talking about this always happens through every, go back to Babylon, go back to Roman times, like civilizations rise and fall. It's a natural, it's a natural occurrence over time. And he says these civilizations tend to have seasons, right? There's a spring season. Imagine when, people just came from Europe and got to America, and there was a race from the East Coast to the West Coast, and people were snatching up hundreds of acres of land, and then the railroad came through, and then improvements in cities, and so this is the spring season. And then you have a summer where everything is in bloom, and it's great, everything's rocking. And then you go into the fall, and things start to slow down, and bureaucracy starts to come in, and taxes, and perhaps environmental causes, and all these things. And then what happens is the arteries of the economy get clogged, and they go into a winter season. And then typically in these winter seasons, which Neil says we've entered into. I just finished watching the Strategic Investment Conference by John Malden. Neil spoke several times. He had a keynote presentation, and then he was on a roundtable. And he explained that we're in this winter season, and it's not good. Like, these are the time periods where there are civil wars, there are world wars, currencies fail, governments are toppled, and that stuff is scary. But as you point out, Dan, what follows winter? Spring.
Yeah.
So if you know what's coming, and you can protect yourselves, and you can keep some of your capital, there is an incredible period ahead of us. But the next 10 years between now and 2030 could get a little rocky. It's going to get cold outside.
It's winter, and as Neil says, it's winter is the crisis season, right? Mm-hmm. The last crisis was World War II. Mm-hmm. Things that he says in that book all make sense. We don't make the same mistakes that our parents made because they're too fresh in our memories. We make the same mistakes as our grandparents and great grandparents,
Right.
and you look at the way we're treating women right now in this country, and around the world, and you look at how we're treating the Jewish people in this country and around the world, it's so reminiscent to the last winter of our journey here in the 100-year cycle, as Neil calls it, right? But yeah, and you're right. There's a spring, and what are the alternatives? I mean, you're an American, you live in America, you need cash, you need money. I know your mentor, Rich Dad, Poor Dad, I don't need money, right? He doesn't need the money because he makes so much every month, right? So you have to cycle in, cycle out, you don't need cash. But if you're an investor in a long-term invest, I'm not a trader. You need a currency to buy low, right? Because that's where the money is, right? Buying low. But I love gold, I love silver, I love a lot of the metals. I like land like you do. But you got to have a lot of cash and a lot of equity in that land, because if you're borrowing that money, you could get hurt. No doubt. I'm not a big fan of Bitcoin, although it's an alternative and I get it. And I have a currency in my business model, if I can ever get there to build it the right way. I'm all for alternative currencies, but in its current form, they scare me. No underlying asset, no real bank. They're not real secure. We've learned that, but they're an alternative currency. And what scares me most about the Bitcoins, and I was saying this to a client on Tuesday, is they outlawed the data mining facilities in China. Why do you think? They're energy pigs, because it's a blockchain of code, and it's all CPU time, and it takes massive amounts of electricity, right? In China, who's building more nuclear reactors than anybody, right? They kicked them out of there, and now there's a lot in Texas and all these low tax states, but they're an energy pig, Josh. They really are. And we're pushing all these cars onto the grid. Our grid can't handle what we have already.
Yeah.
And it's only a matter of time. And I see, the government wants to control that market. How do they take it? Well, they take it the way their cousin, the Chinese, did, right? It's bad for the environment, right? It's bad for the electrical grids. You got to charge your cars. Bitcoin's bad. Take our digital currency, right? I mean, that's the pitch. If you can see it coming, I mean, that's where I see it going. So that's why I'm not a big believer in Bitcoin the way it is right now, because it's too easy to take over by the government, and they're going to. They're just picking their moment. And their moment's that next big financial crisis. When does it happen? At the end of this year, the beginning of next year? I don't know. Nobody knows, right? They know when they're going to pull it off. If Trump wins, they'll do it. If Biden wins, they'll do it. I don't think Biden's going to be the candidate, because I think they're going to go to convention and talk him out of it, and talk their party out of it, and unveil somebody else. But whatever. I mean, whatever it is, Biden, somebody else. It's going to be a clash. And when you look at, just objectively, when you look at the crowds that Trump gets anywhere he goes, and the 3 people that Biden can pay to walk into his, if Biden wins, there's going to be civil unrest. If Trump wins, there's going to be civil unrest, And what a great time to sell the market off. And it generally happens at presidential elections. That's generally when it happens. It just makes sense, right? You're usually at the end of a cycle. There's a change in government. There's big changes that were a platform to campaign on. This one, we haven't had one. I mean, you can't count COVID. That was a shutdown. After 08, all they did was QE, quantitative easing. And I was calling it the QE bust until, I read Neil's book on vacation, and I was like, whoa, wow. And just one quick thing more about that, Josh, is when I was predicting the 08 crash, I was calling it the housing bust, because it was a housing boom, right? I wasn't calling it a financial crisis. And just to be honest and straight up with your audience here, I thought that was going to be like the tech boom bust. Remember when the tech bust happened at the end of Clinton's, presidency?
Yep.
I thought it was going to be like that, but a little bit worse. I never saw Lehman go belly up. I never saw the Federal Reserve run out of money. Okay. I never saw that. I never saw that coming. I didn't predict that, but it happened. I was calling this the QE bust because I was projecting it as that word, but the Great Devaluation is better, and Neil thought of it, not me, right? But I was calling it the QE bust when it came, and I saw it being really bad, right? Neil sees it worse than me, right? And I think Jamie Dimon thinks it's worse than me because he's the only guy scared enough to go out there and talk about it. All the big banks are shut up, quiet about it. Not Jamie Dimon. He's actually talking about it, right? But I see it being really bad. And there's people out there that see it a lot worse than me.
Let's do this then. I want to circle back just for a second and talk a little bit more about inflation, because inflation is such a big topic, and I don't think that people spend enough time studying the origin of inflation and what it really means. So I want to spend a minute on that, and then let's go from there to what is your Navy SEAL investment strategy, and how are you positioning yourself through what you're seeing as this fourth turning. On Monday of next week, I am very fortunate to speak with a group called Be Wealthy, which is about 70 of the savviest real estate investors and private money loan, let's call them alternative investors that I've ever met. And I've learned a tremendous amount from them. And I'm doing a presentation for them called Inflation Destroys Debt, and it makes intelligent investors rich. And I want to share just a couple of slides to give some context to the amount of inflation that has been introduced to the system since 1971. So for anybody who doesn't know, in 1971, President Nixon temporarily closed the gold window. So prior to 1971, you could actually take your dollar bills into a Federal Reserve Bank and you could walk out with gold coins or gold bars. In 1971, Nixon closed the gold window. It's never been reopened. And at that moment, we became a fully fiat currency. A fiat currency is a currency that isn't backed by any commodity or real value. It's backed by the quote unquote full faith and trust of the U.S. government. Well, let's see how that's worked out for us. In 1971, you could buy a brand new house for $25,000. In 1971, you could pay a year's worth of tuition at Harvard for $2,600. You could get gasoline for 40 cents a gallon, so on and so forth. And if you look at it in a little bit of a longer context, this is a cumulative inflation going back to 1913 through 2022. I wish this was updated through 24, because it would take another like straight up curve from there, right? But what you'll see, and this to me is like the holy shit moment, right? When I look at this and I go, okay, from 1913 through let's just call it 1970, you had a cumulative 284% inflation. Let's just say that price of things tripled over a period of approximately 60 years. That means every 20 years that price doubled. So in 20 years, a piece of bubble gum went from 5 cents.
Yeah, 3% a year.
To 10 cents. 20 years later, it went from 10 cents to 20 cents. Over 20 years, that's not, I mean, there's a hole in the bucket in terms of value, yes, but it's not like the bottom of the bucket is gone. From 1970, which is right about the time just before Nixon took us off the gold standard, that the cumulative inflation from 1970 through 22, there was. Well, this is cumulative all the way back to 1913.
Yeah, but yeah.
So take this, let's call this 2,900% inflation over the entire time horizon, minus out let's just round to 300% inflation over this 60-year period. And that tells you that from 1970 to 22, a period of 55 years, there's been 2,600 100% inflation, which means that a $10 dinner for your family in 1970 now costs $260 to take your family to dinner. And go out to a nice restaurant with, you and your spouse and 2 kids, order a bottle of wine and try to make it out of there for less than $260. It's really hard to do. So what that means is that our life's energy, right? We work. If we're smart enough to save before we spend, we accumulate a nest egg and we measure that nest egg in dollars. And so we look at our financial accounts and we go, woohoo, Dan, I got another zero on here. I'm really getting wealthy. No, you're not. The numbers are getting bigger. We're hypnotized because the numbers on the screen say we're getting more wealthy, but in reality, we're actually getting poorer because the metaphor I use is like, look, if all of the value of the US dollar were stored in a bank and you're coming in the front door making deposits, all the gold, all the value, all your life's energy is being unloaded out the back and is being stripped from you, and we don't even know it. So let me ask you to comment on that, and then let's talk about how we position ourselves in light of this.
Yeah, and you're right on. So right, there's 2 ways to measure, growth or gain or whatever, nominal terms, right? Current dollar terms, and real after inflation, right? Real gain is the gain that you should be looking at because that's after inflation. And yes, right? Inflation's there now, and it's gonna be there for a while. It's not going away. And why? Because they continue to do the same things that they've been doing. Why would it get better?
Yep.
You have to stop doing what you're doing to bring on inflation, to stop inflation. And they're not, right? They have no intentions to balance the budget, right? Right. And you think about it right now, their deficits are not slowing down. At some point, they're going to have to keep monetizing debt to try to stop rates from going to 15% or 10% or whatever, right? But it's not going to stop inflation. It might stop rates to some extent, right?
Yep.
You have to stop doing what you're doing, and they're not, right? So, okay, so now inflation is going to be part of it. Like I said, I like gold, silver, guns and ammo as a hedge, right? I like that. You got to have cash. You have to. It's a depreciating asset. But if you're going to buy low, you need to have it. The other way is to build yourself a portfolio, that Navy SEAL team of stocks, right? That can outperform the averages and by a lot, right? So you can cover the cost of inflation and then some. And it's really not that hard, Josh, right? It's math. It's all the law of large numbers. And I'll give it to you. I'll give you a little quick synopsis here.
Please.
Right? The average mutual fund owns between 500 and 1,500 stocks, okay? And 115 million Americans own mutual funds. And that's just Americans. That's not the rest of the world, right? And they own on average 4 different mutual funds, right? The Dow Jones Industrial Average is only 30 stocks. So the average investor is trying to outperform 30 stocks with like 5,000. The math makes it nearly impossible to do, right? But again, people don't buy mutual funds for performance. They buy them for diversification reasons,
right?
Which is the reason why Wall Street says you need a lot of it, right? To smooth out the ups and the downs, which isn't true. Just look at what mutual funds did in 08, and they'll do worse after this crash or correction or whatever you want, devaluation, whatever you want to call it, right? So if you have that 5,000 stocks to be 30, it's going to take you longer to recover and longer for you to earn, right? So I preach to my people, less is best. One, there's less risk with a smaller portfolio. They move up faster, right? They don't go down as much, less volatility, less risk, more gain, right? So most Americans, in the number one mistake that most investors make is they don't employ a diversification model that has any chance of success, right? So I tell people get smaller, get leaner, get stronger. And I'm pioneering a science I call the science of strength, right? I developed a model called the 1551 allocation method. And it's simple. It's all centered around 15 stocks. That's not what the 15 means, but it is 15 stocks, right? A Navy SEAL team of stocks. I have a method of selection and validation, right? That makes those soldiers SEALs, right? Make sure you're investing in strength, right? And that portfolio will outperform the market averages. And I don't care which index, any mutual fund on earth, any index, NASDAQ, I don't care which one, market diversified, than anything that's out there now. So I say to people, why own foreign mutual funds when you can own the best parts of the market and outperform it all with less risk? Why wouldn't you want that? Right?
That makes a lot of sense. So tell me, Dan, how are you positioned that like from a asset allocation percentage, gold, silver, potentially gold and silver stocks, your Navy SEAL team stocks that you hold, your cash allocation, real estate? How's that pie broken up for you?
Well, I tell people now, no more than 15% in stocks, and
And
if it's
that's your Navy
long-term money,
SEAL 15 stocks that you focus on.
yeah,
Okay, got it.
because like it's buy low, sell high, right? And my whole method is a market indication. I use the market to help me tell me what I should do, as opposed to
Sure.
trying to guess what's going to
So if PE ratios are stretched to hell, you're going to lower your allocation.
lower my allocation in stocks. And I'm as low can be. And everybody has a different risk tolerance and need, um, time horizon, all that stuff comes into play. But I tell people right now, this stock market right now is still valued 30-40% higher than the height of the tech boom. You
Right.
can't compare this economy to that economy. It's not even close. I mean, really, honestly, that economy was growing like 4 or 5% in real terms. This one's down negative probably in real terms, right?
Yes.
But I say no more than 5%, 15% in stocks, and low as 5 or 0 if you're really scared, right? Gold, 35%, 25%, 45%, but me, cash, right? Because
Sorry, before you go on, can I go back to gold? When you
yeah.
say gold, there's a lot of ways to own gold. Are
Yeah.
you talking about bullion in a safe? Are you talking about an ETF that is backed by physical gold? Are you talking about?
For gold, I do ETFs backed by physical gold, right?
Okay.
GLD, right? Something like that, right? Just because the gold bar, and when I say gold, I really mean hard assets like precious metal
Yeah.
and guns and ammo, because both of those will increase too and have been. But gold, so think about this. Gold goes from 2,500 to 3,000 to 10,000. You got a gold bar. You're going to go someplace with that. And what are they going to give you? What are they going to give you for that? Cash, right? Cash is a depreciating asset. Do you really want to cash that much gold in? Then you get cash, or you barter silver. You make the transaction that much more complicated, right? So I own a gold ETF, and I own physical silver. I call it crisis capital, and I right because that silver coin goes from $25-$30 to 100. I could go buy groceries with that.
Yep.
I could go buy gas with that. I could go to a pawn shop, and it's only a small denomination of currency I'm exchanging it for at any given time, right? So I don't have to take on a huge depreciating asset. With a gold coin, that 1 ounce of gold could go really to $5,000-$10,000 in a blink of an eye. And what are you going to do with it? Yeah, you got it. But what are you
How
going
do
to
you
do
buy
with
a
it?
loaf of bread with and a dozen eggs with a gold coin? What about gold miners? Do you invest in gold miners at
I
all?
don't. It's not one of the places I go. I think I don't know enough about it. I'm not a geologist. I think you'd have to be to really make hard plays in there. And I don't want to pay someone
It's a
else to do it.
perilous realm.
Yeah.
I'm with you. Okay,
Yeah.
keep going. So, and what's your you said 35-ish in commodities, hard assets there.
Yeah, hard assets, no doubt about it. And then the rest, I mean, for me, because I'm a stock guy, cash. I mean, because I need a mechanism to buy low, and that's where all the money is. So cash is not a money maker, right? Cash is a mechanism to make money. That's all it is. If you're in stocks, right? In ETFs and that, hard asset ETFs and stuff like that. So to me, I've been waiting for this for so long. I can't wait for it to happen because I'm 57 and this is my last real big chance to capitalize on something, knowing full well that even though I'm deploying a Navy SEAL team, you know, those guys get into some tough battles and they're not quick wins, right?
Yeah, there's going to
And
be a
this is
few
not going to be a
that
quick
die on that
win.
mission.
Yeah, this is, we're in the winter, and you know, winter's several months. It's not an overnight thing, you know. But I'm going into war with a portfolio that's proven, tested, and strong. And that's the only way to buy when the world is falling apart, because this world is going to fall apart before spring comes, let's say.
So Dan, when you say cash, are you in treasuries? Are you where?
No, money market account, easy to deploy. And again, if the central bank digital currency thing, and that's where I see it going, and I'm not the only one, of course, and they have to reset this debt or devalue the debt and reissue debt. I mean, do you want to own that debt? I don't want to own that debt. And why would you want to own debt now when a guy like me is forecasting higher inflation? You know, inflation is the cost of money. Interest rates or yields are the cost of borrowed money, debt, right? Right? They should be a function of each other. Interest rates should be a lot higher than they are now. The only reason why they're not is because the Federal Reserve has been monetizing debt to keep them low. But how they can't keep doing that, right? So, like, you look at central governance with the deficits and the debt, right, and the money and the way they've monetized and inflation, they've backed themselves into a terrible corner. I mean, it's frightening, right? I mean, you know, guys like Howe can project it out 15, 20, 30 years. I'm not that good, but I've been seeing this coming for 10 or 15 years, and there's no doubt about it. But it's going to be bad, without a doubt. And that's why I say people need to educate yourself, need to get yourself set up for where you're going in your future, whatever your future is. You know, you're in a different situation than I am. Your audience is in a different situation than we are. But you gotta like keep your eye on the mark and the ball and educate yourself what's going on and have a plan that could actually win in that circumstances, you know, because somebody wins in these wars, right? And like I say, the ruling class or the donor class that funds the ruling class, you know, they all get wealthy in the stock market, right? Nancy Pelosi, her trades are famous. There's websites that track what she does, right? That's their mechanism to make money, right? And there's a close relationship with big business and big government. Let there be no, which is the reason why every time government gets bigger, so does business, right? And that's what we as a people should not want, because there's more competition and better pricing with small companies than there are big ones, because they become oligopolies.
So let me ask you, we'll go back. I want to go back to the money market thing, because my understanding of a money market account is essentially it's an account that then your bank deploys into different bonds and treasuries. So aren't you still at risk of a devaluation of the currency there? What am I missing?
Yeah, you are. I mean, listen, if you put it in under your mattress, you're at risk for devaluation. So yeah, you're at risk with it, but you got to have it there so you can buy them all.
Immediately liquid. So if the crash happens tomorrow, you can deploy 5%. If I've got my money tied in a 3-month treasury, I got to sell at a discount. I got what you're saying. Okay, it's just, there's just a little bit higher element of liquidity.
Yeah.
I got it.
And remember, you're now in a market. You're in a bond market where speculators are speculating it's going to go a lot lower. They want to buy it at a bigger discount. Your bonds.
Got it. Okay. Super helpful. And I just want to net one thing out that I've observed from your portfolio construction here. If the economy keeps chugging along, Dan's Navy SEAL team of 15 stocks are going to drive the performance of that portfolio. If the world goes to hell in a handbasket, then gold is going to drive the returns of his portfolio. And then if the world goes to hell in a handbasket, as Howe and many others are saying, now Dan deploys that money market funds to buy those 15 Navy SEALs at rock bottom prices. And he's basically got the best of both worlds. Hey, you know, bring on the storm clouds. Gold's going to go up. My stocks might suffer. So what? I'm going to deploy capital and buy more Navy SEALs. It's a brilliant portfolio construction. Okay. So let me ask you a quick question, because I think a lot about inflation. And there's a story of a gentleman who owned a diamond mine in Germany. when they had the, hyperinflation of was it the Weinmark? Do you remember what that currency was called?
No, I don't follow. No, didn't follow.
Okay, let's see if I can find it really quickly. Yeah. Here it is right here. Okay, so, there was massive inflation in Germany, and this was in 1922. And basically, their currency was inflated to the point that people were throwing the currency in the fire to warm themselves because it was so devalued that it was worth more as fuel than it was to, go buy something with it. Yeah. And there's this story of this guy who Hugo Steins is his name. He became the richest man in the world right before he died. And what he saw was this hyperinflation coming. And so what he did was him and his family were already investors and owned diamond mines. But he said, you know what I'm going to do? I'm going to borrow as much money as I possibly can from all these German banks. And I'm going to buy these diamond mines, which is kind of like buying gold and silver. It's another hard asset, right?
Yeah.
And then when the inflation went insane, it essentially drove down the value of that debt because the value of the currency that was borrowed in, that underlied it, was destroyed. And then that whole currency went away and was rewritten with a new currency, similar to what you're talking about with the digital currencies that will replace the dollar. And then there's a write down or a reissuance of, hey, if you owed $1 million in dollars, now you owe $10 in the new digital currency.
Right.
And so I've thought about that and I thought, what an absolutely brilliant plan. So in my mind, I'm allocated 5% cash. I'm actually more about 10% cash right now. 10% cash. I'm about 5% cryptocurrency and about 10% gold. So that's about 25% of my portfolio. And then I'm 75% real estate. Now, the reason I like the real estate is it provides me cash flow.
Right.
And my bet is that the $47 million in debt that I owe on my real estate will be devalued and rewritten into some central digital currency, which means I won't pay back 47 million. I might pay back 4 million. So poke holes at that. Where do you think?
Yeah, you could be right. You could be right. And I don't, I don't blame you for having a low cash balance when you're in real estate and you have that reoccurring income. I get it. But most of my people and me, I'm not built that way. I'm not a real estate guy. Right. I can't poke holes in that. I don't know. Like, what's the government going to do with you, right? Somebody that has 47 million in debt versus someone who only has a couple million in debt, right? What's that deal look like? What's that revaluation look like? I don't know. I really don't know when it comes that, one, I don't trade in that market enough. I haven't researched that market enough, but I'll tell you what, I mean, it's scary, and I don't know. I mean, it could go either way. What happens if they make it 87 million? Our currency, land-based assets has a different categorization than people that have credit card debt, because they want the spending more than they want, long-term, growth. I mean, who knows? I mean, I'm anti-establishment. I'm an independent. I don't trust these guys one bit at any turn for anything. You know what I mean? I don't put anything past them. So I like your portfolio. I like your concept. And I don't know. I just don't trust them to make, you richer. Maybe they will. I don't think they want to make any of us richer. I think they want to steal wealth from all of us, to be honest with you.
Well, there's no doubt about that. I think you're spot on. I'm going to share one closing thought, and then I'm going to pass it over to you to give your closing thought here. And then we will, I'd love to hear where people can get a hold of you, Dan. So, hey, I pull this up often on the podcast, and it's the US debt clock. And, I go here if I, want to have a glass of wine and cry by myself. But the amount of data that is in here is, it's actually incredibly enlightening just to spend some time through these different pains and to learn about how money is moving through our economy. There's a bunch of great information on gold in here, as you probably well know. But, we're approaching $35 trillion in debt. and $1 trillion is really hard to imagine how what the vast amount of money it is. But I saw a visual representation, Dan, that said if you were to take $1 trillion physically, you would fill a football field, not just the 100 yards, but also take in the other 10 yards or whatever that is for the end zones. And then you would fill the entire football field with pallets of $100 bills 6 feet tall.
Yeah.
Holy
Yeah.
shit. I mean, that's an unfathomable amount of money that we owe. But the really crazy part that you talked about was, our official spending is 6.6 trillion. The actual spending, because there's all this off balance sheet stuff that somehow they hide, is 6.7 trillion. And oops, we're only bringing in tax revenue 4.8 trillion. So we're adding, well, this will be by the end of this year, certainly, at least $2 trillion. And we've been adding a lot more than that. It's been if you look backwards, it's been more like $1 trillion every 3 months that we've been adding. And this deficit just continues to grow and grow and grow. And I just don't see, I don't see a path correction other than the rewriting of the US currency, as you're talking about. There's only a couple ways to get out of this. It's confiscation and it's inflation. And I don't know any other way to get out of this thing. So I think you're right. Confiscation is a very real potential outcome here.
Yeah, and think about in the next 3 to 5 years, $17 trillion of that 35 trillion is becoming due. We don't have the money, so we have to refinance it.
Yes.
And we have to refinance at higher rates.
Yes.
I mean, when you follow the money, and I follow the money to pick stocks and everything else, but when you follow the money here, it ends really bad. Mises said it long ago, if you keep doing this, you're gonna destroy your currency mechanism. Because there's no way out of it. Either you abandon it voluntarily or it crashes on you. What do you want to do? They're not abandoning it. They're going to let it crash. And again, government, create the crisis, let it crash, and then go fix it. And fix it by what? Stealing more liberty, right? And creating another fiat system that they control more than the last one, because that's what they're in it for, right? The central bank digital currency is so corrupt at its core because now they can shut you off for any reason at any time. Oh, you're going to a restaurant again today? I'm gonna block your mechanism of payment. Oh, you want to buy a gun? No, I don't think you deserve a gun. You block your method of payment. Anything, a vacation, you don't earn enough to have a vacation. I mean, that's what we're up against. I mean, with the digital currency, because it's only a matter of time. They abuse everything. I mean, the Patriot Act, when George Bush, and I was against it when it started, but did George W. Bush, when he signed that thing, ever think it was going to be turned on parents at school board meetings?
Crazy.
Well, it is. I mean, they abuse everything. I mean, Social Security, a good idea, a voluntary system only to help certain people. Look at what they've done to it. They bankrupted it. It's gone in 2034, which is around Neil Howe's end of the winter season, right? I mean, and it's just it's a scary situation. But I have a friend who's an American citizen now, but he's from Russia, and he's from Western Russia, and he's got family in Eastern Ukraine. And so a couple of years ago, when this started, I said, "Hey, Vlad, what's really going on over there? Tell me about it." And he's just said, listen, this was always going to happen. And if you go back 25, 30 years and just chart it, it was only a matter of time. And he picked his moment. And here it is. It had to happen, though. And that's what historians and prognosticators like Neil Howe, analyze and use, right? But if you look at where we're going with our currency right now, it has to come to a major reset, a bust, a crash, a devaluation, because it's been charging that way for 10 or 20 years. And if you ask me, they've really been, encouraging a civil war since then in the last 10 or 20 years. They really have. And it's sad. I mean, we can't even talk with each other about these issues without, oh, Trump this or January 6th that, or, forget about politics. Politics is corrupt. Let's talk policy. right? Let's talk about the policy of monetary currency creation in America. Can we do that? Right? Because you forget about politics there. It doesn't matter. Just talk about fiscal spending. Forget about Democrat, Republican, right? Is it healthy to spend this much money? And don't think of you. Think of your grandchildren, because that's who you're screwing them. And no one does that, right? And really, we have to stand above the fray. And investors might forget about Democrat, Republican. When you join my network and we talk about investments, forget about politics. It's not about that. It's about policy and how it affects us, we the people, and our money and our retirement. That's what it's about. Forget about everything else. I don't want to hear about anything else. There's plenty of venues for that. Go talk about that there, not here.
Really well said. Dan, it's been a pleasure, my friend. How, if people want to take back their finances and get educated, and as I mentioned earlier, that inheritance of passing on that inheritance of not just money, but passing on that inheritance of wisdom. How do they find you? How do they learn from you? And how can they get a hold of you?
Well, the easiest way is either one of my websites, loseyourbroker.com. If you go to About Me, you can find it. You go to my business website, Cal Management, calmgt.net. You can find me there. And right now, I'm building a platform for independent investors. It's going to have an online university. It's going to have a think tank.
Nice.
And it's going to have like a support forum,
Community.
webinars, online chats, community. Yeah. So in LinkedIn, connect with me on LinkedIn.
Well, when you get that up and running, or anytime you want, I'd love to come teach that Inflation Destroys Debt presentation. It's a real eye-opener.
Love to have it.
So let's stay in touch, my friend. Thank you for sharing so generously with our community, and we hope to have you back again in the future.